Before we start the video, please take some time to read through the important notes and disclaimer. Do note that investments always involve risk and the possibility of losses. Any reference to prediction, projection, forecast on the economy, stock market, bond market, or the economic trends of the markets or past performance is not necessarily indicative of and is no guarantee to the future or likely performance of your investments.
Hi everyone, I'm Jalissa, the investment analyst at AutoWealth. Here with me is our Chief Investment Officer, Taiji, and together we will walk you through the pandemic turnaround portfolio.
Thank you, Jalissa. Today, we will be introducing to you the pandemic turnaround portfolio. As the name suggests, the pandemic turnaround portfolio identifies economic sectors that are expected to benefit significantly from the post-pandemic economic recovery through exposures in consumer discretionary, lithium producers, renewable energy, aerospace, and home construction sectors. All of our portfolios are specially curated by the investment team to reflect a particular theme or investment strategy or style that aims to deliver strong returns. Our portfolio curation process largely includes these three simple steps. Firstly, extensive qualitative and quantitative analysis is carried out to determine the sectors that express the investment theme. The ETF's weightage are then derived to track the respective sector market capitalization. Our team then screen over 10,000 available ETFs listed globally and select the best ETFs for your portfolio based on various criteria such as diversification effect and risk-adjusted returns, etc. The process doesn't stop here. Our portfolios are reviewed regularly to ensure that the underlying ETFs are consistently the best ETF available in the market, and the allocation weightage is relatively consistent with the market. Now, Jalissa will share more about why you should be investing through the pandemic turnaround portfolio.
Thank you, Taiji. So the pandemic turnaround portfolio is one of our more uniquely designed portfolios which aims to capitalize on the COVID-19 event to earn above market returns. A systematic two-pronged approach was adopted to construct the portfolio. First, we identify turnaround sectors, which actually refers to sectors that are either temporarily depressed or likely to benefit as a result of the pandemic. Secondly, we review the shortlisted sectors to ensure that they have historically achieved sustainable market returns over the long run. As the world emerges from the COVID-19 pandemic, you may wonder, is this portfolio still relevant? And our answer is a resounding yes. Economic recovery has been somewhat delayed by the evolution of new variants and more recently Russia's invasion of Ukraine and the Fed's aggressive rate hikes. Therefore, these stocks continue to be priced at a discount to the market and we believe have the potential to outperform from an eventual market rebound. Let's now take a look at the last 5-year performance chart of the underlying sectors. All 5 sectors have outperformed the reference benchmark MSCI All Country World Index and the weighted average return of the portfolio was around 92.5%. So now let's take a look at the 5 underlying sectors in greater detail. First, let's take a look at the largest component of the portfolio, consumer discretionary. Though the sector has been one of the most badly hit by inflation, it is important to note that consumer spending, as backed by large cash savings, remains strong and consumer spending economic data is still growing. US consumers have twice as much cash savings compared to pre-pandemic as a result of stimulus checks and suspended spending on expensive experiences like travel. The medium-term outlook of the sector also remains positive for the following reasons. First, let's look at retail, which makes up 45.2% of the consumer discretionary sector. The pandemic has accelerated several long-term growth trends, including e-commerce. E-commerce sales are expected to rise steadily and will account for more than 30% of retail sales by 2025. Amazon, the largest company in the consumer discretionary sector, is likely to continue to dominate the US e-commerce market, with a market share of close to 40% as a result of its expansion into categories like home, apparel, pets, and healthcare. Next, automobiles make up 18.1% of the sector, with Tesla being the second largest component in the sector. Electric vehicle sales nearly doubled in 2021 and are expected to grow steadily, driven by the rising interest in electric vehicles and supportive government policies to fuel electric vehicles adoption. Thus, the longer-term trend towards e-commerce and electric vehicles is likely to continue to support the fundamentals of larger companies in the consumer discretionary sector like Amazon and Tesla. Next, governments are compelled to provide fiscal stimulus to pull the economy out of the COVID-19 pandemic contraction. Many countries focus their fiscal stimulus on clean energy in an attempt to green their recovery. US public money spending on clean energy projects reached $16.1 billion. US rejoining the Paris Climate Agreement and Biden's economic recovery plans shows commitments to tackle climate change and create opportunities for the lithium and renewable energy sector. Let's dive deeper into the lithium sector. The demand for lithium is expected to continue to grow and is projected to reach 2.4 million tons in 2030, driven by booming demand for electric vehicles. Transportation is currently the largest source of US pollution, and the government is working towards transportation electrification. The Inflation Reduction Act, which was recently passed to tackle climate change, includes several provisions which are expected to accelerate electric vehicles adoption. Batteries, which accounted for 95% of lithium demand, are projected to grow at a compound annual growth rate of 27%. Despite soaring demand, the global lithium market remains tight. The long lead times, declining resource quality, and climate risk poses risks to the ramping out of lithium supply. Lithium supply crunch has become a pressing concern, and the global imbalance is expected to worsen with increasingly severe lithium shortages from 2025. Therefore, we expect lithium prices to remain elevated. Likewise, the renewable energy sector is now set for an unprecedented boom in the US in the wake of the Inflation Reduction Act, which includes $369 billion of funding for climate and energy investments and aims to reduce greenhouse gas emissions by 40% below 2005 levels in 2030. With this climate policy, the momentum for clean energy projects is expected to accelerate, and the capacity of wind and solar installation is estimated to increase by 50% and 35% by 2030 respectively. The aerospace sector is slowly recovering, with demand in business and leisure travel picking up as more countries open up. Such demand is supported by low rates of unemployment and high levels of precautionary savings accumulated during the pandemic and will continue to support the industry's recovery through 2022. Changi Airport, one of the world's busiest airports, has reached a tenfold increase in the total number of passengers as compared to 2021. Most defense contractors are likely to see increasing revenues in 2022 as defense budgets around the world continue to expand moderately. In the US, defense policies such as the $762 billion National Defense Authorization Act will support growth in the sector. Aerospace and defense companies that focus primarily in defense, such as Lockheed and General Dynamics, saw positive earnings growth in 2020 despite the pandemic. As compared to commercial airlines companies that were badly hit by pandemic restrictions, aerospace and defense companies were much more resilient and insulated from the pandemic as a result of its dominant revenue share from government defense spending, justifying our bias for selecting aerospace and defense over the airline sector. In the home construction sector, supply continues to be limited by supply chain disruptions and manpower shortages, resulting in a lack of active home listings on the market. In the home construction sector, supply continues to be limited by supply chain disruptions and manpower shortages, resulting in a lack of active home listings on the market. According to a research by Freddie Mac, the US had a housing supply deficit of 3.8 million units in the fourth quarter of 2020. Despite the sky high of more than 7% mortgage rates, home prices continues to rise, reflecting a very resilient market. The increase in first-time home buyers and domestic migration as a result of remote working has led to the growing demand in the market. Once supply bottlenecks are fully resolved, the housing sector is expected to boom, supported by persistently high demand. Lastly, why do we allocate 10% to a minimum volatility ETF, in this case USNV, in our portfolio? The minimum volatility ETF seeks to track the index composed of US listed firms that exhibit low volatility characteristics, which helps to provide downside protection for your portfolio. As seen from the left chart, minimum volatility have a track record of delivering market-like returns with less risk, as they have historically been more defensive during market declines while still capturing meaningful gains during market upswings. During market volatility, USNV is observed to lose only 67% of the total loss accumulated by the benchmark. This is again proven during the COVID sell-off period where S&P 500 recorded a 12.35% decline, while USNV recorded a slightly smaller decline of 11.93%. All investments involve risks, and here are some key risks you should be aware of. In the near term, consumer discretionary is likely to be depressed by elevated inflation. However, we expect consumer sentiment to improve and spending to pick up once inflation cools. Lithium mining has received increasing attention for its adverse environmental and social impact. We believe that government pressure and a rise in ESG investing will motivate firms to work towards cleaner and safer mining operations. Though renewable energy is highly weather dependent and adverse weather conditions can adversely affect revenue, technological improvements have helped to mitigate such risks with improved energy conversion efficiencies and better energy storage and transmission. In aerospace and defense, the possibility of another global pandemic disrupting supply chains is real, but the economy is likely to become more resilient and supply chains are likely to overcome disruptions faster and better. In home constructions, elevated mortgage rates are potentially discouraging potential buyers. However, this is expected to be temporary, and mortgage rates are expected to moderate and normalize over the long run. So moving on, Taiji will share more on the potential risks and returns.
Thanks, Jalissa. So, what are the risk and performance numbers like, and how does it perform compared to a benchmark? Let's look at the returns first. While the portfolio has slightly underperformed as compared to the MSCI All Country World Index in the recent 1 year amidst the inflationary environment, the portfolio has significantly outperformed the reference benchmark on a longer run basis, 3 and 5 years. The pandemic turnaround portfolio achieved a 5-year annualized returns of 17.89%, whilst the reference benchmark achieved an annualized return of 8.79%. From a risk perspective, the portfolio's annualized volatility of 19.63% is significantly lower than the reference benchmark. On the maximum temporary drawdown, an indicator of downside risk, the portfolio has also performed better with a smaller drawdown of negative 31.94%. Overall, if we look at the Sharpe ratio, the portfolio has a Sharpe ratio of 0.85, while the MSCI All Country World Index has a Sharpe ratio of 0.33. This suggests the pandemic turnaround portfolio is able to generate higher excess return relative to the risk taken as compared to the reference benchmark. As mentioned in our introductory video, AutoWealth Plus portfolio are 100% equity and tends to be more volatile than the AutoWealth Starter portfolios. The pandemic turnaround portfolio is ideal for investors who wish to capitalize on the global recovery from the COVID-19 pandemic event and earn potentially higher returns. However, as the underlying sectors are more cyclical in nature, investors should have a longer time horizon of at least 5 years, with a high risk tolerance to withstand market volatility that can occur from time to time. If you are interested, all you need to do is to follow these 3 simple steps to create an AutoWealth Plus portfolio today. Firstly, to open an account with us, you need to head over to our website and click Get Started. Next, you create the AutoWealth Plus portfolio by clicking the Plus tab and follow the instructions to fill in your goals, information, and risk assessment. Lastly, you pick a preferred AutoWealth Plus portfolio and start funding your account. Thank you for watching till the end. If you have any queries, please visit our website or drop our client services an email. Help us to improve our video content by scanning the QR code. We hope to bring you more content like this in future. Stay tuned and see you again.